In January 2026, silver shattered records, spiking to an all-time high of $121 an ounce. This chart tracks that price action, showing how quickly the momentum evaporated. A 30% collapse erased months of gains, culminating in a brutal 7.7% single-day drop in mid-May, pushing the price back down into the mid-80s. But looking at the exact same timeline, the underlying physical market reveals a massive contradiction. We're currently in our 6th consecutive year of a structural supply deficit. The world is consuming far more silver than it mines. To see the scale of this shortfall, we can look at global inventories at the COMEX. Those vaults have bled out from 531 million ounces down to just 315 million. Basic economics dictates that when physical supply vanishes, the price goes up. Yet, the price of this asset is collapsing at the exact moment the metal is disappearing from the earth. To understand why the price is plunging while the vaults are emptying, we have to look at the asset itself. Silver is caught in a macroeconomic identity crisis. First, it operates as an irreplaceable industrial commodity. It is highly conductive and essential for manufacturing modern technologies like solar panels and electric vehicles. Second, it acts as a monetary proxy. Institutional investors trade it based entirely on the direction of central bank interest rates and the strength of the US dollar. Third, it serves as a geopolitical safe haven, a hard asset that capital flees toward during regional instability and global warfare. The crash in May 2026 is the direct result of these three massive macroeconomic forces colliding and turning against each other in real time. Silver's high electrical conductivity makes it essential for the green energy transition and digital infrastructure. It is a key component required to power artificial intelligence data centers and scale global EV production. When the price surged past $120 an ounce, that essential component became a cost that threatened the very viability of high-volume manufacturing. Faced with soaring material costs, solar manufacturers aggressively accelerated a process known as thrifting. They re-engineered their photovoltaic panels so that the expensive silver paste could be replaced with cheaper copper wiring. This chart visualizes the immediate institutional fallout. Analysts at UBS slashed their 2026 silver deficit forecast by 80%, dropping their projection from a 300 million ounce shortfall down to roughly 60 million. At the same time, the highly anticipated Trump-Xi summit concluded without a formal long-term trade deal. The resulting uncertainty paralyzed future tech procurement orders across the Pacific. The rapid price spike engineered its own demand destruction, forcing global supply chains to innovate away from the very metal that sparked the rally. While industrial demand softened, a second opposing force emerged from the macroeconomic data released in April 2026. The U.S. Consumer Price Index showed inflation running at 3.8%. Stubbornly refusing to cool down to target levels. This presented the Federal Reserve with a strict mandate. They cannot cut interest rates while inflation continues to surge. The arrival of incoming hawkish Federal Reserve Chair Kevin Warsh reinforced this policy path, locking the economy into a higher-for-longer interest rate environment. High interest rates act as monetary gravity. They drive up Treasury yields and strengthen the U.S. dollar, reducing the appeal of holding a non-yielding physical asset. The final variable in this equation is the regional conflict between the United States, Israel, and Iran. The escalation in the Middle East pushed oil prices past $100 a barrel, injecting a stagflationary pressure that guarantees inflation stays elevated and the Fed remains hawkish. But this chart highlights a critical structural constraint on the supply side. 70% of the world's silver is not mined directly. It is extracted as a byproduct of copper and zinc mining. The conflict has severely disrupted regional base metal operations, including those in Iran. By halting these massive open-pit copper and zinc mines, the war inadvertently chokes off the global supply of byproduct silver. Even as monetary gravity and industrial thrifting push the price down, this geopolitical disruption ensures the physical shortage persists, preventing a total collapse in value. So we return to the contradiction. How does the price crash when the vaults are empty? The answer lies in separating the market into two distinct environments: the physical reality of dwindling bullion and the financial reality of paper futures contracts. The spot price you see on a screen is dictated entirely by the cost of money and institutional expectations for the future, not by the immediate scarcity of the underlying physical metal. In the short term, the sheer volume of algorithmic trading and margin liquidations easily overwhelms the actual supply and demand of physical silver. When tested, the raw power of institutional capital flows and Federal Reserve interest rates dictates the immediate price action, superseding physical shortages. In the modern financial hierarchy, silver functions as a direct competitor to gold's role as a primary monetary anchor. It now functions as a hypersensitive barometer for the broader global economy. It is caught in the crossfire between the technological demands of the AI and green energy transitions, geopolitical instability, and central banking's ongoing fight against inflation. Navigating this market requires looking past the physical inventory in the vaults. The actual price of silver is determined by the macroeconomic vectors that control global capital.